Hey everyone, welcome back to the Hub channel. Brandon is out this week, so I'm sitting in for him. And joining me, as he does each week, is Jeff from Ewo Trader. Welcome, Jeff. It's great to
Hey,
have you
John.
back on the show.
Great to be here. Glad to be with you.
And a busy week starting out in the markets. How are you finding things so far for a Monday?
Well, yeah, a bit alarming, but lots of volatility, and that's the way we like it. So,
Excellent. Well, look, we're going to kick off with the show here. And just to recap for everybody, we're going to take a look at the trades that Jeff has been giving us in the last couple of weeks. There's a Philip Morris trade that in particular that he's been working. And we're going to take a look at that because it's performing just the way that he anticipated that it would. And then we're going to move on. We'll take a look at the major indices and Jeff's outlook for the US market. And then finally, towards the end of the show, Jeff's going to give us a new trade for this week. So stick around for that. So with that, Jeff, let's jump into that Philip Morris trade and how's it going?
right now it's doing exactly what we wanted it to do ahead of earnings that are coming up for Philip Morris. We have a calendar spread, just a basic calendar spread. And as we take a look at the chart, we have what we call a risk graph. So we've modeled the trade, we've modeled the calendar spread. So what you see on the right-hand side is essentially the risk graph for the trade. And you can see that if you focus on the blue line intersecting the red, blue line being price, that's the horizontal line, and the red line being today as far as where the trade is. And we go to the very bottom of that, and we see that we have a nice little profit, well, of about 42%, actually 43% profit in just 2 weeks. We put this trade on just 2 weeks ago. And the reason was, we were in between earnings, not much was happening. And so we focus on other delta neutral strategies that can help us make a little bit of money in between events. And counter spreads are just one of the many types of delta neutral trades that we can do that will allow us to benefit from things like time value. And this is a trade that you can find in our Delta Neutral Trader publication, which we do each and every week. I come out with trades like these calendar spreads, and we can we'll be watching this for the next probably week, because Philip Morris has earnings that are coming up, and I don't necessarily want to hold this through earnings. I don't think so. We'll probably take this off next week, and we'll look for a profit. My profit target is between $100 and $200 here on this trade. So that's what it's looking. That's what it's looking at right now on that.
And is that kind of return pretty typical of what you're seeing out of these calendar spreads?
Right. We can. What the great thing about calendar spreads is that you can, depending on what the stock does, anywhere from 0.5% or 50 basis points on the spread to 200 to 300% return is very very likely on a calendar spread. Typically, I don't take them right up to expiration where that max reward is of 200 to 300%. But here we're just targeting, essentially targeting doubling our money, and that's very reasonable for a calendar spread.
Very reasonable and quite a tasty trade, if I can say that. Now, I know normally on this show you are doing the breakout trades, and if anybody's interested in your whole delta neutral approach, great to have that combination of income trades with a calendar, but also breakouts with the straddles and what you're normally doing on that. So if anybody's interested, there's the guide that they can go ahead and download at that link, ewotrader.com/straddle. So jump onto that and grab Jeff's guide if you're interested in having a look at how he usually sets up the breakups on the breakout trades on the channel. Now, with that said, Jeff, we might move on to taking a look at the market and how you're seeing things.
Yeah, let's take a look at headlines here as we go into looking at the markets. Really the main headline is the declaration of war that Israel has made upon Hamas. This really caused the markets to react. And interestingly enough, the Teflon U.S. markets are holding strong. Now, that's not the same in oil or in the energy space or in interest rates, but the US markets are holding their own. And oil prices, as I mentioned, are surging under this attack as unrest in the Middle East can cause havoc with oil prices. In fact, I have an image of the XLE, which is the Spider Energy ETF, and the components therein. And you can see that other than Pioneer Natural Resources, which were down 0.5% when this image was taken, everything else is well in the green. You see ExxonMobil, which is the largest holding in that ETF, is up 3.4%. I see ConocoPhillips up 5.5%. We're up almost 100% of the stocks in that space are up today, as well as crude oil. So we could actually see a spike at the pump, depending on how long or how severe this unrest is in the Middle East. So that is kind of one of the areas that we're looking at over the next couple of weeks is that sector. But let's look at the rest of the broader markets. And I'm going to start today with IWM. And the reason is because last week I showed an image of IWM, and I forecasted pretty much a zigzag pattern to the downside. Okay, I drew on my chart that the IWM would drop, which it did, and then we would rally, which we are, right back up to around the 175 mark. Now we're at that point right now, but I would anticipate that we might rally a little higher before we start moving down. Okay, but that down move towards that pivot point down there at 165 is still in play, even though we've rallied from here. In fact, if we come to my chart and we'll pull up IWM, you can see here that we've jumped about 58 basis points today. Ironically, that is kind of typical for IWM. It's a lagger, okay, right now. Sometimes it's a leader, but we're right up touching that 174 mark. We got a little bit to go to 175, but the 165 is still in play, okay? I don't know how long this rally can support us, but we'll see. We want to listen to our charts, and we want to trade the charts. So with that said, let me jump over to Spider and start with that, because boy, this is really telling a tale here. We have a stock that came down to support here at around 420 and held. And if I put my moving averages on here, let's see, put my moving averages on, you can see my long-term moving average is at it held at the 161. So my long-term moving average is the 161 period moving average. And you can see my short-term moving average, which is the 21 period moving average, dropping severely right now. And it's almost to a point. In fact, on one of my algorithms, I did get a buy signal today for the Spider Index Trust, but I think I'm going to wait till it gets up and probably crosses my short-term moving average to take off my bearish trade that I have on and go to the long side. If I show you my Heiken SG chart, you will see why. Okay, we are really holding at our first bar that has no wick on the bottom. Now, I am not surprised really that number one, we held at 420, which is pretty decent support. That's my long-term moving average also. And we were getting a little what I call wicky at this level. Now we've got a big green candle with no wick on the bottom. I need one more candle. And the way Heiken Hashi candles work, that'll give me a day or two more before I pull the trigger. If I get another green candle without a wick on the bottom, then I'll take my hedges off that are protection to the downside and put something bullish on as it relates to the broader market. Otherwise,
And
yeah, go ahead.
can I jump in there? I was going to ask, if you start to see a signal to the upside, what would your target be to that upside on the SPY?
450. This previous pivot back up here, 450 would be the short-term target. I actually do have a longer-term target of 490 by the end of the year. So, and that's just coming from the charts. Now, I don't know if we're going to get there. We're already now in the second week of October. That would be a huge rally if that happens. So, but that's what the chart was telling me 2 months ago. All right. So that's kind of what I put out there at that time. A good trader adjusts, but right now I would target this previous pivot right up here at 450 on this SPY.
All right, so that's pretty interesting. A lot of uncertainty around that news. How are you seeing the Qs and some of the other indices, Jeff?
Well, what's interesting, NASDAQ is not really responding like the broader markets are. They're up 51 basis points today, which actually is, well, Spider's only up 64 basis points. Qs usually were leading, but you'll notice here that on my chart, in fact, I can clean it up a little bit. We have the Qs closing possibly above. In fact, I think we just did closing above my short-term moving average, and that would warrant me then once again applying my hike and a she, looking and take a look at this. It's pretty much the same story. Okay, we have a lot, very wicky. Not surprised that we held at this area. And now we closed right on my short-term moving average. If we get another green bar without a wick on the bottom, we're going to rally higher. And it's time to take off the hedges and place some bullish trades. My target there would be this 380 to 385 level. That would be my near-term forecast if we get that bullish trigger, just 380 to 385 for the Qs. Now, looking at jumping back to kind of the energy sector, we have USO. It's up 4% today. You know, everything was dropping in the energy space pretty hard. Oil prices were coming down, but USO is up big today, up over 4%. We'll see if there's any follow through. It's expected that there will be, but one day does not make a trend. So I would just kind of sit and watch something like USO to see if we do have a reversal of fortune here. Jump back to my typical candle chart. You can see the gap. All right, just this thing is not only has it gap up today, but it gapped down 3 days ago. So we had a huge gap down 2 days in a row. Now a big gap up, getting really volatile in the crude oil market. Energy space is definitely something to watch. Now, also something to watch are interest rates. Interest rates are dropping today. And if we start with IEF, we have a big jump in IEF, which is the 7 to 10 year Treasury bond ETF. This means this jump reflects a drop in rates. All right. Now, this is happening across across the whole bond market. Now, interestingly enough, today was a holiday. Even though markets were open, bonds were closed. Okay, it was a banking holiday, Columbus Day here in the U.S. We will see what happens tomorrow. That will really tell the tale. Now, TLT also had a big day, up over 2.75%, meaning rates on the long end of the curve are really dropping. The short end of the curve, not so much, but the long end of the curve, rates are dropping. Now, this is going to be very interesting because a short-term retracement in interest rates could, given the current environment, be a catalyst for a much higher push in interest rates later on. In fact, last week, Rick Santelli, who appears on CNBC, gave his forecast for long-term interest rates. And this was very eye-opening. Rick, if you're not familiar with who Rick Santelli is, Rick is a former bond trader and has traded in the pits in Chicago for 20 plus years before he became an analyst on CNBC. He is one of the few talking heads that are still welcomed on the floor of the exchanges. And if there's somebody that knows his stuff, and especially bonds, it's Rick Santelli. Rick made a forecast, a long-term forecast that was very, very shocking. He mentioned in his appearance on CNBC that over the next 7 years, rates could go as high as 14% on the 10-year. An amazing run. He gives the exact trade in this video. We'll include a link to that video underneath this video, or you can go look it up. Rick Santelli, 10-year treasury hits 13, 14%. You can find that. It's actually being spread everywhere right now. And he actually goes through the charts and says why his forecast is for that high, but it's long-term. It's actually a 7-year window. That's something to be wary of, okay? A lot can happen between now and 7 years, but it's really based upon our spending habit that we have here in the U.S. from our U.S. government and the U.S. Treasury, okay? If it continues on the path, we could see those double-digit interest rates. So pretty amazing stuff happening really in every complex, energy, broader markets, and now bonds. So the fact the bond market, we'll see what happens tomorrow, but we have something else that's coming up that we always look forward to, John, and that is earnings. Earnings are right around the corner. In fact, I could smell it right now.
I know you're excited about earnings. I know you just had your new breakout strategy service released at eWord Trader as well. And I was watching one of the presentations that you were giving, and I think you said that there was somewhere in the order of 5,000 companies announcing earnings over the next several weeks. And I know you're excited about the opportunity that brings to traders.
Yeah, this is this. In fact, this week is the lull before the storm. We really get cranking next week, but this week there's some big names even this week that are declaring. There's about 105 companies that have earnings announcements this week. We started today with Applied Digital. Tomorrow we have PepsiCo as kind of the headliner. That stock typically is such a Goliath that it really doesn't move much around earnings. Probably do a different strategy for that one. But it's really Thursday that we're keying in on, because in the morning we start with CPI, the Consumer Price Index, and then we have earnings, a slew of earnings before market open, including Delta Airlines, Domino's Pizza, Fastenal. And then on Friday, big financials, Citi, JP Morgan, Wells Fargo, BlackRock, and then the insurers, United Health Group and Progressive. That is a big key day. So I'm looking actually not just at one stock, but at several as my target for this week, including Domino's, because it's football season. And this should be a time when they are really doing well as far as their sales go. But who knows with this economic situation, are people scaling back? All right. And then the financials, goodness gracious, with higher interest rates, you'd think they'd be doing well, but that's also making credit harder to get and fewer people taking loans. You could have an argument either way on how financials should be looking this earnings cycle. But I know one thing, it can be very volatile, and we're going to keep our eye on that.
Absolutely. So it looks like most of the activity is later in the week. So Thursday, Friday are going to be interesting. And Jeff, What about your trade that you've got for us this week? What are we looking at?
Well, I really kind of mentioned it. I'm really focused on Domino's Pizza, um, and um, and the potential for what they have in store. So, if I pull up a chart on Domino's, we have a stock that has shown some volatility already. Now, that is what I'm a little concerned about. Okay. This back here, this gap actually was not an earnings related event. Earnings actually came a little time later. But the fact that we've dropped look at that, right down to my long term moving average and held at my long term moving average. Um, this may be set up for a opportunity here for a little bit more volatility. With it trading right at 350, which is a big round number, that kind of gets your attention a little bit. Especially if it consolidates here for the next 2 days before its earnings event on Thursday. So Domino's Pizza is really the one that I'm looking at. Good opportunity to either put a straddle on or a strangle and ride it through that earnings event.
Awesome, Jeff. So this is going to be another breakout trade, not one of those income trades like the calendar that you had on Philip Morris. And back to what we've been talking about more on the channel as far as breakouts around earnings.
Right. That's the thing about the breakout trades is earnings are the real catalyst, and when we're in between earnings, well, we can either not trade, we can take some time off, or we can put on other trades like the Philip Morris trade that can generate us a little income between events. But now we're getting into our season. We got a lot coming up. I'm very excited about the next 4 to 5 weeks. The last earnings cycle, we just killed it. Almost every trade that we gave out during the last earnings cycle on this channel was big time profits. I think one was a small profit, but everything else was we were just knocking it out of the park, and looking forward to another volatile earnings season again, trading options. So it's going to be fun.
Awesome. Thanks, Jeff. Appreciate you being back on the channel. And just as a reminder for everybody, if you want to get Jeff's guide, the breakout trading style around earnings, you can go and download that at ewotrader.com/straddle. It's a great guide. I think it's something like 18, 20 pages, and there's a lot of detail in there. So really worthwhile having a look at that if you want to understand the way Jeff trades. And with that said, I think we can close out the show here. Once again, Jeff, thanks very much for joining us, and we'll see you next week on the Hub channel.
Week.
Thank you.
Great. Have a good one.